Simon, you're live.
Hello, everybody. Simon Dixon here. Hope you're all well. Welcome to another AMA this week. And this week, we're going to be discussing the real price of stocks. We're going to be going through some different charts today. So hopefully my screen share will all work. But I wanted to cover a few different ways of looking at the stock market at the moment, how it relates to Bitcoin, how it relates to gold, and some of the things that you need to know before we start jumping into your questions. So the way the AMA session works is we will cover a special topic, and the topic is the real price of stocks. And then the rest of the show is really dictated by you and what questions you want answered. So you can ask me questions on Twitter or use the live chat here on YouTube. Azad is here with us to pick out your questions and moderate. He is suffering with a bit of hay fever at the moment, so hopefully we won't get a sneeze or cough attack. And don't be alarmed; it's just the season that we're in right now. But he'll be pulling out your questions as well. So in terms of the real price of stock, I set a challenge to my audience the other day. And just before I jump in, remember to like, share, retweet, so that we can make sure that as many people as possible that might have exposure to their pensions and various different markets can get to watch this content. So I really appreciate that. I shouted out on my Twitter, if you're not following me at Simon Dixon Twit, I give exclusive little quick captions with my phone where I update my Twitter followers. And one of them was requesting a little challenge, which was to create some charts for this. And I promised that I would share those charts as part of the discussion. And I'm going to do that right here today. So there's three charts that I requested. One was a chart of the S&P, the usual S&P chart, which is priced in dollars. The second was the S&P priced in gold. And the third was the S&P relative to Bitcoin, so priced in Bitcoin. The reason that I wanted this is because most people think in terms of their reference currency. So as the largest market in the world, the stock market in the US, one of its indexes is called the S&P 500. And it's really a benchmark at which many pension funds and fund managers either try to outperform or use as a benchmark for determining their success. So the way that traditional markets work is you start with a currency, and in this case, we're talking about the dollars, and then they accept that there's inflation. You can't really trust those inflation figures because they change over time, and that is used as a political tool in order to try and make the statistics that a politician wants in order to be re-elected look better. But nonetheless, you can adjust charts accordingly. But the reference point is really inflation. Central banks try and target a set amount of inflation each year. Most of them agree that it's about 2% per annum is a healthy level of inflation. And then they try and do all sorts of things in order to try and achieve that. And then those that are managing your money, i.e. you contribute every single month to get a pension, their benchmark is trying to beat inflation. And they do that by investing in stocks and bonds. Bonds are lower risk, which produce income. And in a world of negative interest rates, and we are in a bond market bubble because you're getting negative returns often compared to inflation in real terms. And yet people are still purchasing those because people need to try and put their dollars somewhere. So they end up lending it to the government and receiving the returns, or different types of bond markets as well. And then in order to try and achieve what they need to achieve, which is approximately 7% per annum for a pension, then they have to invest it in higher risk asset classes, and those tend to be stocks. And they always use the benchmark in terms of dollars, inflation, beating inflation, and the stock market. And then you have something like the S&P 500, and you try and beat that to try and beat the market. It's worth noting that approximately 86% of all funds don't beat the market. So many of you pay exorbitant fees for underperformance when you're contributing to your pension. which is why a wave of index funds, which are low-cost ways of essentially getting exposure to the whole market without trying to beat the market, essentially kick the shit out of all managed funds, with the exception of a few. But anyway, I'm going to pull up some charts and give a quick shout out. So hopefully the screen share works now. And if it does, you should see a tweet here from Paul Jones. And I assume that the brr is referring to all of the dollars that are being printed in the printing press, which is not quite being printed at the moment. It's actually done through a digital entry in the central bank's balance sheets. They create that money, and then the government borrows it through the bond markets, and they issue these assets and repay the central bank plus interest. The central bank then prints off some more money and starts buying corporate bonds as well. And now central banks all around the world are actually purchasing equities. You've got traditional, I did another one just before I go into these charts as well, because I wanted to cover it. The new show, Bitcoin Hard Talk, we recorded our first episode today. And we just released a teaser, which is with the legendary billionaire investor, Jim Rogers. And we had a whole discussion around what we were just talking about as well, how even things like the Swiss central bank, which was traditionally a very safe central bank, a haven and a politically neutral haven, has really been using their funds to actually buy stocks in Facebook and various other companies. So even those traditional safe haven central banks are being backed by tech companies in Silicon Valley, which is a very strange turn of events, but nothing makes sense anymore. That's the markets that we're in. But I asked for this chart to be created, and here's the first one. So the first thing to note with the S&P 500, even if you go way, way, way back, 200 years of history, we have been through situations like this. We've been through debt cycles. We've been through Great Depressions. We've been through wars. We've been through famines. We've been through, Spanish flus, all sorts of things. And the S&P has always recovered. So the S&P, unless you sold, has never taken any money out of anyone. We're not quite at all-time highs at the moment. But the fact is, if you look at the chart, it tells a story about how the S&P always recovers. And so that's why so much money makes its way. This is actually a similar story for all stock market indexes, with the exception of one, which is Japan. Japan never recovered from their massive, ginormous bubble and lost decade. And it's still not returned to new all-time highs. But if you look at the chart and you listen to Donald Trump right now, he'll tell you about how America's the best, America's the greatest, America's doing more tests than everyone, America's the best place in the world, and tell you the whole story. And the stock markets are getting close to all-time highs. So why is that? So we've got record levels of indebtedness. We got record levels of unemployment. We got record levels of poverty within the United States. You got record levels of government debt, and you got record levels of bankruptcy. And yet the stock market is really not reflecting reality. So there's a couple ways of looking at it, and then I want to go into a bit of an explanation. My explanation for that is that half of the stock market strength is not necessarily the strength of the markets, the strength of American companies. Although, that's a part of it, obviously. But a lot of it is to do with the economics of the dollar. And that's why we're going to discuss a little bit today. So when you price the S&P to the dollar, you get the story that Donald Trump and politicians and everyone want you to see. And that is a strengthening dollar is really driving up the demand for dollars. And therefore, in order to beat inflation, when the governments are essentially devaluing the currency, an attempt to devalue the currency by printing more, why is that not really having the inflation effect? And it's because a lot of it is making its way into foreign ownership, foreign debt, and therefore it's being used in order to beat inflation and go into assets like stock markets and various other assets. But a slightly different story is if you actually price the S&P relative to gold. So why are we pricing it to gold? Well, the dollar is obviously subject to the forces of, when you have a US stock market priced in a US dollar, then you get all the funkiness of a central bank and a treasury being able to do things with the dollar in order to paint a rosier picture and stimulate investment, malinvestment into certain industries. But what if we price it against gold? Well, we get a slightly different story. It still looks like we're in a bull market, but you'll start to see that actually the stock market, when priced in gold, is entering into a bear phase rather than having that sharp recovery. A lot of that is to do with the strength of gold, but as gold is a politically neutral, many would argue that it's been manipulated over time, and there's certainly interesting things to discuss there in another video. But you can see the difference when you price the S&P in gold relative to dollars. We're not quite getting that strengthening effect here in this bounce up and moving to all-time highs. And that is showing you that there's games going on with the dollar that can't be played with gold. Now, just for fun, what if we price that against Bitcoin? So this is an interesting chart where we price the S&P against Bitcoin. And you'll see that we are in a deep, deep, deep bear market in terms of Bitcoiners. So if Bitcoiners put some of their money into the S&P 500, this is what they would have seen relative to their Bitcoins. So what we can tell from this is that if we have three forms of money, let's start with the dollar. So we got fiat currency, but as in fiat currency being the strongest fiat currency, for the reasons that we'll go through in the second part of this video. We're in a stock market bull, we're headed to all-time highs. But if you price it in more scarce hard money, like gold, you get a different story here. But then the harder the money, the more scarcer the money, Bitcoin is the most scarce and our world's best shot at achieving digital sound money. You get a really, really different story. You get a bear market. This is essentially the stock market Great Depression when you're using Bitcoin as the matrix for pricing S&P 500. So this is interesting to think. And this really makes the foundation I know I've talked about that I'm going to be releasing a free video series on what I will be doing throughout the Great Depression of 2020. I'm looking for more corrections because I want to see the stock market weakening in dollar terms due to some of the fundamentals of the current markets and environment that we're in. And then I will be using that in order to accumulate a traditional and crypto-based portfolio designed to survive inflation, deflation, good economic times and bad economic times. And sometime in August, I'm going to be releasing that really in-depth free video series. And in September, I'm going to be taking on a bunch of people that want to actually build it with us as well. But the reason that I cover that is because gold, US dollars, and Bitcoin become really important parts of that portfolio. So I'm going to stop sharing my screen now. I've gone through those charts. So thank you very much to Paul Jones for creating those charts. And hopefully I haven't butchered your middle name, but I'm pretty sure it's something to do with the printing presses at the moment. Yes, so let's move to the second part of the analysis. So I've gone through those charts. So why is it that the demand, that the stock market, I'm claiming is being pushed up by the demand for dollars? So many people would think right now that, the America is essentially, with this latest rounds of unlimited supply of dollars that they're willing to give to both the US market and the international markets. One would have thought, most people would think that causes inflation. And eventually that causes inflation, but initially is offset by asset price destruction, debt destruction. So if people are defaulting on their debt, then that offsets any of the effects of inflation. And so while we're not getting the large inflation effect, obviously we haven't had enough time, I do expect that we are going to see an inflation effect, and in fact a bubble in the demand for dollars due to some of the trends that I'll be discussing today. More and more people are demanding dollars. So dollars are essentially, if you check out the interview I did that's coming out later this week on Bitcoin Hard Talk with Jim Rogers, we were talking about the fact that most people see dollars as a safe haven, and therefore the demand for dollars generally increases. So in terms of real growth in an economy, you've kind of got a few things. You've got real productive growth, which is where entrepreneurs are creating new businesses that create new innovations, new breakthrough innovations that then lead to an increase in employment, and therefore you get real growth based upon real productivity. But there are a few other ways of stimulating an economy using more funky methods. One is trying to increase the velocity of money. So the velocity of money is that when banks create money, when they issue it as a loan, they create a digital currency. And if you just leave it, they create a digital version of the dollar, essentially, if you're borrowing in dollars in a US bank, through a US bank. But if you just leave it in the bank, then it has a zero velocity. Now, if you spend that, it then gets deposited into somebody else's account. And the more time it recycles, the more it can be used as collateral by traditional fractional reserve banking theory, which, by the way, if you check out my other videos, did an interview with Professor Stephen King. Sorry, I keep saying that. I'm going to get myself in trouble. The book Stephen King, Steve Keen, somebody that has really been involved in the monetary reform for a movement, talked about how the fraction and fractional reserve banking doesn't actually exist. So head over to Simon Dixon, subscribe to the channel, hit the bell symbol, and you'll get all notifications, and you can go through some of the archives right back to before the very first Bitcoin conference in the world, and me speaking at the first Bitcoin conference, and lots of the very first TV interviews and various other things. But back to this, velocity of money. The more it recycles, then the more people are spending their money rather than hoarding. Then this can create a stimulus effect, which leads to more debt being created, more digital currency, digital dollars being created. And therefore you can stimulate economic growth just by trying to stimulate the velocity of money. This is the very reason why in the last Great Depression in 1933, the president actually barred the hoarding of gold. So they made it illegal for Americans to own gold because people were hoarding their gold, and that was decreasing the velocity of money. And because the country was actually in a gold standard at the time, that would actually control how much quantitative easing and how much money printing could happen at the time, because it would lead to a depletion in the gold reserves for the Federal Reserve or the central bank. And so many people blame the depression on the gold standard, but really it was just trying to rein in government's natural tendencies to try and use credit creation and the velocity of money to get itself out of a depression, rather than actually experiencing asset price deflation and leaving the markets to do what they do. The other way of stimulating growth is credit creation, obviously. So if a bank, if banks are creating all of the money, then if you can get consumers to take on mortgages, then you can create new money in the supply, and then the velocity of money can increase. And therefore you get an effect based upon credit creation. It's why individual consumer debt is increased at the same rate as the stock markets. Business debts are increased because then the businesses borrow the money through credit creation. That then increases the velocity of money as they spend it. And then they also put it into the stock markets, which creates the record all-time highs and recoveries. But most of the growth, the real growth, what a country really wants to see is productive growth in companies and employing people through real innovation, real growth in companies, rather than credit creation using the velocity of money. And remember, most of this credit doesn't necessarily make its way into business. It tends to make its way into speculation. Just going to have a sip of water. Excuse me. While I'm taking that break, we'd be really grateful if you could like the video. The more people that like it, the more YouTube and the algorithms help us to get more people to see it. And as I said, we're going to be releasing that video series towards the end of August. So we're really putting some great effort into that, and I think it's going to help a lot of people in terms of figuring out how to actually navigate how I'll be investing during this Great Depression of 2020s, and some of the thinking behind that, so that you can actually understand it as well. So really appreciate it if you can share and get more people to see this message. So what happened during the breakout of this pandemic? Essentially, everybody sold everything. So they sold their Bitcoin, they sold their stocks in the initial phase when it was actually announced of the lockdown. And they sold all of their assets for dollars. Now, why would they do that? The reason for that is because the demand for dollars is at record all-time highs, simply because the US has been exporting its inflation globally. So because the US has been creating all of this quantitative easing money, and countries like China, if you see other videos where I talked about currency wars, have been selling goods for dollars. They get converted at the People's Bank of China, and then they buy treasuries and various different assets. So the US is creating all of these dollars. A massive chunk of them are making their way abroad. And so all of these central banks now have dollar reserves, they have gold reserves, and they also then invest them in US government debt, which has created this environment whereby approximately 70% of all currency in the world today is dollars. And almost 55% of all global transactions happen in the dollar. And so when people are actually holding dollars and then investing in dollar-based debt products, and then you have organizations like the International Monetary Fund and the World Bank issuing dollar-denominated loans, the demand for dollars continually increases in order to actually pay off some of those debts, not the investors, obviously. The investors are reinvesting it into dollar-denominated assets. But those who've actually taken out the dollar-denominated loans, they call them like aid loans and all sorts of stuff, the demand for dollars continually increases. Now, of course, only the Federal Reserve can print those dollars. So that gives the US a very, very strengthening position. So if you can get most countries in dollar debt, and you can get trading partners, mega trading partners like China, dependent upon the dollar, then you can export your inflation by them having to create lots of renminbi every time they buy those dollars. Then essentially you create this massive, massive global dependency upon the dollar, which is where we are right now. Others will even devalue their currency in order to try and export more goods, as I've talked about in other videos. And this leads to this demand for dollars and dollar-denominated debt really being a dominant force. So you may want, so the end result is, so why does people sell off their gold, their Bitcoin and all stuff for dollars? Well, you may want gold, you may want Bitcoin. What are the people living, month to month doing right now? They may want their assets, but because they've got debts based in dollars, they need dollars in order to pay down their debts and not get repossessed. So the demand for dollars in the debt-based economy gets this strengthening and strengthening and strengthening. And the fact that asset classes like gold, oil, and the world's largest stock markets are all priced in dollars means that you end up having those US dollars being reinvested into markets. And then when you have organizations like the central banks and the Federal Reserve pumping money into those stock markets as well, you don't really have traditional fundamental analysis of being able to analyze markets. It just kind of disappears, and you enter into this quasi government stroke free market, socialist stroke communist stroke capitalist. There's not even words to describe the market that we find ourselves in today. Remember the effects that this has as well. When the demand for dollars increases and there's lots of dollar denominated debt, they can use instruments like derivatives as well in order to actually start taking away power from other countries. So let's say that you have a bunch of your own currency. You can't print it because you don't have the power of the dollar. Therefore, you're not on a level playing field with the Federal Reserve, because everyone else has to worry about hyperinflation from overprinting of money. But if your debts are denominated in dollars and the dollar is getting stronger and stronger, then derivatives can be used, it's called the swap markets, to actually swap your local currency for some dollars. And then those dollars can be used in order to service some of those debts. And essentially, these derivative swap markets can be used as political tools, because the US can then just switch off these USD swaps and then essentially just take all power away from a country to service their debt, cripple them into bankruptcy, and then repossess all of the country's assets, and essentially nationalize, but with a foreign ownership, is what you're going to see as a result of many of these US dollar denominated debts. Now, the reason that we're entering into an interesting phase is because we're at the end of a 75-year debt cycle, and the dollar's getting stronger and stronger, even though it's more and more people, more and more of them are being printed, and the supply is flooding the markets, because a lot of it is making its way abroad and not necessarily. Some of the policies are getting it in domestic through helicopter money and various other things. But it's also making its way into the market, and the velocity of money is not increasing. So therefore credit creation is not increasing. So it's not causing inflation yet, because you're also getting debt destruction and bankruptcy. But a lot of these dollars are making their way back into the stock market, back into the bond markets, creating bubbles there. And essentially, we enter into a phase where eventually the US can't pay off their debts with more debts, because that's never worked forever. Some people believe that it can work forever. And then eventually you enter into a monetary renegotiation phase, which is what I've talked about in other videos. This is where gold and Bitcoin and other things come into play. So central banks that have enough gold, the large central banks that have been accumulating larger gold to GDP ratios, like countries like Russia, Europe, which is essentially Germany, and then large gold producing nations. One of the reasons why the gold reserve won't return is because the largest gold producing nations like South Africa and Russia, they don't want them to have more power. But gold is the highest gold to GDP ratio is Russia, is China, is the US, and is Europe, represented by Germany. The other countries won't get a seat at the table. Their best bet is to take an asymmetric bet on something like Bitcoin, which is what I've talked about in other videos, and I talked about in Bitcoin Hard Talks when I was trying to help Jim Rogers understand why we believe in Bitcoin and some of the different scenarios. And so really what you're seeing right now is the fight between US dollar denominated assets, gold, and Bitcoin. And so when I'm thinking of how I'm preparing, those are the key fundamentals of preparing for US dollar still being part of the monetary renegotiation, believing and knowing that gold is a hedge against internet failure, and Bitcoin is a hedge against you not being able to get your gold, and also being able to transact globally in a time like lockdown when you can't fly over to Singapore or fly over to Switzerland in order to accumulate the gold, because you have to leave it with a custodian most of the time, unless you're putting it under your mattress. This is why. So the makeup of the portfolio, when I'm talking about it, is playing these different trends and trying to achieve different types of yields on these trends and preparing for different scenarios, moving into a deflationary, inflationary environment as well. The other thing that's really interesting is central banks are also playing the same game, but not all of them will be able to play it. So that's where Bitcoin creates a bit of an asymmetric bet, because one thing they do have is electricity, but no one necessarily wants, for example, the Lebanese currency right now. You can't use it to buy anything because people are scared of it, but they do have electricity. And so electricity can be reallocated towards mining to make an asymmetric bet, which I think is what some of the smaller countries should be doing if they want to actually gain a seat at the table of the monetary renegotiation. But essentially, this is why I think of the stock market in terms of Bitcoin price, dollar price, and gold price, because we're going to have a monetary renegotiation. I think these are going to be three important tools in that. This can happen at any stage, obviously. We don't know exactly when it's going to happen, but the time to prepare for it is before it happens, not when it happens. This is also why I think certain trends, and coming to the end so we can go through your questions on the AMA, this is also why I think Ethereum has a place in a crypto portfolio, because many of the on-ramps for countries that just can't simply get access to banking or can't simply get access to the dollar markets, they can use stable coins, and most of those stable coins, some of them exist on Bitcoin, but most of them exist on Ethereum right now. So therefore, that's driving up the demand for Ethereum as more and more of these stable coins, which are backed by dollars or denominated in different fiat currencies, but allow you to send money as easy as sending an email, become a really interesting thing, especially when they're yielding in a time when there's negative interest rates. Now, obviously, that yield is because it's higher risk. The first rule of the market, the higher the returns, the higher the risk. But this concept of an asymmetric bet is where you can get disproportionate returns. And that's why I think Bitcoin is many people's choice of an asymmetric bet, as it's a speculative store of value. You see other videos that I've created, like, is Bitcoin good money, to help you understand the difference between that. But this is why I think these different trends have a place in these different markets. And this takes me also, round circle, where you're comparing US dollar denominated assets with gold, with Bitcoin, and you're making sensible, diversified approaches. And that's what I'll be covering, the exact makeup of that and some of the secret sauce in doing that during the 4-part video series that I'll be releasing, hopefully in August, if everything goes to plan, and then doing an actual course with a group of students in September that want to join me to do that with them. So that's why I'm bullish on the demand for Bitcoin, ETH, gold, and dollar, and preparing myself for any of the eventualities that could come from that. That's all the content I've got for you before we actually jump into some of your questions. So how did I do for time, Azad? So I took up half the time. That's cool. We'll have the other half for questions. So Azad, are you there? Are you coughing or sniffing or?
No, I'm fine. I believe you kind of coughed on your own water, or lack of. All right. Yeah, we're getting questions come through. Thank you very much for all your questions. We've got 198 people watching. We'd really appreciate the support if you hit that like, share, and comment. So I think the first question we'll ask, we've got a few questions from Twitter, and I think I'm going to do one that's related to the topic. We do have more questions that's unrelated to it, but regarding stock price, I think the question I'm going to ask is, will the stock market crash in 2020?
I would love to give you a straightforward answer. If markets were real, then the absolute answer in my perspective would be yes. But what I can't forecast is what politicians will do. I can come up with a set of scenarios and map the effect on the stock markets based upon that. But the markets are no longer markets. Fundamental analysis no longer applies. We are in a QE-led market, and we are in a Federal Reserve-led market, and politicians at Treasury and politicians are going to be dictating whether the market should crash or fall. But we call it a stock market, but essentially it is no longer a market. Market forces and market dynamics no longer apply. So what I'm preparing for is politicians creating inflation, creating deflation, creating economic decline, or creating economic prosperity. And depending on the timing and particular decisions that they will make, will determine whether we enter into an artificial bull market or we enter into a market correction. One thing is for sure, the stock market does not reflect the realities of the world. Nobody is borrowing money to excessively consume right now. The velocity of money is low. And the markets are 100% propped up by the demand for dollars, people not knowing what to do with their dollars, and the funky new instruments that are being used to prop up the markets while we enter into the monetary renegotiation, similar to what we saw in Bretton Woods and various other negotiations. It's a bit of a cop-out, but I think the markets are completely overvalued right now relative to the current position, but that doesn't mean that markets will prevail. And so that's my answer to that one.
I think this is quite a popular question, especially on the internet. How do you get rich in a recession?
How do you get rich in the recession? The secret to getting rich is you've either got to create something and take ginormous, excessive risks by investing everything you've got into a business like I did at a time when I was pretty much $100,000 in debt, gave up everything I've got, all the time I've got, everything I could put into, and then beat the odds of making a business succeed, which 90% won't. And so you have to be either an excessive risk taker. And for most people, that's a really bad strategy that could lead to bankruptcy and all sorts of excessive indebtedness, like it did throughout different stages of my life. But if you get one of those and it works, then your shift focuses onto wealth preservation rather than excessive speculation. So in your younger years, you can take excessive risks in order to try and get asymmetric returns, which is what creating a business essentially is. And then if you succeed at that, which most people won't, unfortunately, then you shift your focus to wealth preservation. Now, the easier path and the less risky path, which everyone can do, is if they can get themselves in a position where firstly they have an income, then the secret to getting rich is essentially spend less than you earn, invest the difference, and keep doing that and compound for the rest of your life. And the funny thing is that the first one involves taking excessive risks. And really the odds are that you will really ruin your financial situation if you take that strategy. The second one is something that everyone can do, but very few do. Most people, they try and spend beyond their means because they want the goods that being rich will give you. So they do it on debt, and then the debt takes them in a situation where they can never spend less than they earn. Then therefore they can never invest the difference. And if they can never invest the difference, they can never get on the right side of the debt cycle. And therefore they remain in the debt cycle forever. So as unsexy as that is, That is the difference. And in terms of how to invest the difference, that's the video series that I'll be creating during the current markets of exactly what I will be doing. Now, I can't promise you. All I can say is that my days of excessive risk taking, I'm at a stage right now in my life where I'm thinking about preservation and therefore taking less risks. And therefore, when you take less risks, you would expect lower returns over time. But a lot of people, what they do, especially in the crypto markets, they try and take a little bit of money, put all of it into one altcoin, for example, one ICO or one IEO, and try and just get rich quick. And there is a plethora of vultures out there that will all tell you, videos of here's my top 5 picks. And they'll drive you into a gambling mentality where you're thinking, what's the fastest way of getting rich as fast as possible? And that will be the exact reason why you lose all your money if you don't get lucky the first time and then start thinking about wealth preservation. So my simple answer to that is you get rich in 2 ways. You take excessive risks and you create something that during this depression, people are going to demand, and it works out, and then you focus on wealth preservation, or you simply buckle up, spend less than you earn, and learn how to invest the difference and make sure that you get on the right side of the speculative curves. And that's exactly what I'm going to be covering in the free video series of exactly what I will be doing during the current markets. And I'll be doing it in 2 ways. I'll be taking $1 million of my savings so that those of you that have savings can see how I would do it. And I'm also going to be doing it with assuming 0 savings and just taking a percentage of my income, spending less than I earn, investing the difference, and showing exactly how I would do that. Now, the good thing is you don't need to FOMO. There's a phrase in crypto called fear of missing out. You don't need to FOMO into this, because the more you spread this, the higher it performs. One thing I've learned at banktothefuture.com, we've been involved from, with we got over now 90,000 investors that got incredibly wealthy over the last decade. Some of them started with nothing. Others of them have achieved billionaire status from nothing over the last 10 years. And the reason is because I think that people vastly overestimate what wealth they could achieve in 1 year and underestimate what wealth they can achieve in 5 or 10 years. And 5 or 10 years in today's market goes really, really quickly. But it's overestimating what they can make in 1 year that drives them into speculation, gambling, 125x leverage on crypto exchanges and all sorts of crazy behavior that's guaranteed to destroy your wealth at some stage, all because they are overestimating what they can do in 1 year and underestimating what they can do in 5 to 10 years. What I've learned at Bank to the Future is the people that generated real wealth, real sustainable wealth, did it tax efficiently so they got to keep it, protected it in a way where they can create real legacy beyond their life through inheritance planning. They were all long-term thinkers. They didn't trade. They bought into a long-term investment theory or a way of managing money, and they stuck to it. They still benefited from some of the gambling, and I've done that in my time, money that I've put into more speculative things like crazy off the scale risk, like ICOs and IEOs and things like that. But I only ever did it with the percentage that I was more than happy losing and never allowed it to affect the main portfolio. So it's all about money management, having a long-term plan, accepting where you are. One of the things that I did when I was 100K in debt is that I really just took the time to do my personal balance sheet, understood how much money I owned, and just took a real look in the mirror at my situation. I obviously decided to take a big bet on business, and I'm fortunate that it worked out, and also took enough off the table even though I went through years without paying myself, but took enough on the table to make sure that I had some Bitcoin, and then developed a portfolio approach to wealth preservation that you can benefit from, asymmetric risks at the same time as hedging for any eventuality. And that's what I think, to me, that is the secret. That's the secret of wealth. And then I'm just talking in terms of money as well. Real wealth is not necessarily a monetary thing. Money obviously really, really helps, but there's a lot more to wealth than just the monetary part of it. And that's where you prepare your life around a life that you'd really like to live. I know I never give short answers, but I like to give thorough answers. So Azad, perhaps you got another question on that.
Yeah, no, everyone appreciates your answer to that. There is a question I'd like, which is similar to what you've just answered, the question that I asked, but I think it's an important one. What's wrong with hard-earned work over a period of decades, like many boomers have done before us? If you're able to give a quick answer to that, that would be great, because I've got another two main questions.
Yeah, I'm not quite sure I understand the question. What's wrong with hard work? Nothing. And I think people should work hard. I think that my personal philosophy in life is one of karma, and I think that it's hard work is karmically good for the soul. I think working hard, I think, is always a good thing, and it keeps the mind spiritually tuned. It makes you feel a sense of worth and contribution. The problem with it, if I'm answering the question right, is most people use work to get into a debt cycle. And that is that because they are not spending less than they earn and investing the difference, they try and consume goods before they can afford them. And some of them just start there. So, I was sold the promise of a student loan. I was told that if I take my student loan, I would go out there and I would get a good job. My first job was in retail, and then I worked as a tea boy. And then I managed to work my way up to investment banking and various different roles. It worked out, but it wasn't from anything that I learned at university. In fact, I still see the university as a valuable part of it. But really, it was part of, driving me into the economics and monetary reform and different things. But there's nothing wrong with good hard work. But most people that work end up spending more than they earn, taking on debt for the difference, and therefore never get in a position to invest. And if they're never in a position to invest, they have to work forever. What I would encourage everyone to do is, put together a long-term plan so that you only work because you choose to. Like, I don't need to work at Bank to the Future. I do that because I love what I do at Bank to the Future. My investments take care of myself. But if you can get yourself in a position where you work because you choose to, because you love what you do, then you're doing the right thing. And that's something that I think everyone should aspire to. How do you get there? Hard work, spending less than you earn, investing the difference, and learning how to accumulate what you invest in, and how to preserve it as well as grow it. That's it.
Okay, thank you very much for that, Simon. We've got just about 12 minutes remaining. We've got about 256 people who are joining us today. Thank you very much for all the questions coming through. Please hit that like, share, and comment, and subscribe to the channel if you haven't done so already. Simon, the question that I've got for you, I think it's in relation to the fact that you've now started your new show, Bitcoin Hard Talk, and you've just made the announcement with interviewing Jim Rogers. And I've seen a pattern here. There's a number of people who are quite frustrated, as I am as well. So I'm going to put this one through. There are lots of talks about central bankers who are showing or expressing interest in Bitcoin. And we also know about the traditional big whales investors out there. So why is it that traditional well-known investors like Peter Schiff express such a dislike or great objection against Bitcoin?
My answer to that is take this video, tweet at Peter Schiff, at Simon Dixon, twit, and ask Peter Schiff if he's willing to come on Bitcoin Hard Talk, and we'll discuss it person to person. So I don't want to speculate on why he's given such a distaste to Bitcoin. I have my theories. My theory is that he's decided that two things. My guess is he has a business that's centered around selling as much gold as possible. And I think he started to notice that people were selling their gold and interested in Bitcoin. And so this immediately started him thinking. Now, I created a video a while ago in one of the AMAs. It was called Who Not to Trust in Crypto. And I talked about the behavioral finance and how different psychological techniques drive you around a narrow vision where you delete all of the information that doesn't back up your belief. So therefore, you have a part of your brain called the reticular activating system that deletes information. It's the part of the brain that when you get a new car, you start to notice everyone else has that car, or you buy some new jogging shoes or trainers and you notice everyone else has them. That's the reticular activating system. It's also the part that deletes the fact that you could be focusing on whether your heart's pumping right now, but your brain just ignores that and does it anyway. So we all have this in our brain. And I think Peter Schiff has triggered his reticular activating system, RAS, for two reasons. One, I think he originally started to notice that gold sales were starting to actually, people were diversifying. And so that started to annoy him. Then the reticular activating system triggered off. So he started to see everything that make him believe that Bitcoin is bad, gold is good, when reality is they're ultra complementary. There's things that gold can do that Bitcoin can't do. There's things that Bitcoin can do that gold can't do. And they're actually very important diversifications of each other. The other thing is, I think he started to notice that the more he hated on Bitcoin, the more attention he got. The more he talked about Bitcoin, as Bitcoin became such an attractive topic. You know, gold became a very boring topic. Bitcoin became a very exciting topic. So the more he talked about it, he got famous as the anti-Bitcoin guy, the Nouriel Roubini strategy, which actually drove more sales for gold. And I believe his business actually accepts gold sales in Bitcoin. So I'm sure he's accumulating a lot of Bitcoin throughout this, or his businesses are. And it's a great way of accumulating more Bitcoin. So I don't fully, that's one way of looking at it. Or you could just say that he's shut off from the possibilities, or maybe we're all just crazy. And he's right, time will tell. But yeah, invite him on the show. We'll talk it out. That's the whole concept of Bitcoin Hard Talks, by the way. I keep saying Bitcoin Hard Talks, Bitcoin Hard Talk. Get in that habit. The reason we created the show is because I didn't necessarily want to just invite people that already love Bitcoin and we can talk about Bitcoin. I'd rather invite people that are not quite there yet, or are against Bitcoin, so that we can have the hard talks about hard money. And really, we can use it as an educational experience to understand what stops people getting into Bitcoin, so that we can try and support more adoption and help more people by understanding what is actually the reasons that's stopping people. Love to have Peter Schiff on the show, so tweet him, copy me in. Maybe you can take a soundbite out of this video, and maybe that inspires him to actually come on the show. But Azad, we'll give that as one of your tasks to try and get Peter Schiff on the show, and we can debate it out.
I think you can see the big smile and grin on my face as you gave that answer. Thanks a lot for that, Si. Okay, one last question before we get your final thought or your last positive say. How long before we see Bitcoin moving from a store of value to actually becoming a large exchange?
I'm going to slightly mix up the question. I think that they might mean a store of value to medium of exchange. Maybe I'm misunderstanding, but I'm going to answer that anyway. Bitcoin is what I call a speculative store of value, which means that it's not quite a store of value right now, because a store of value means that you preserve your wealth, and gold has been the wealth preserver for centuries. Bitcoin is too speculative to be a store of value right now, because the majority of the world thinks it's a Ponzi scheme, a currency just for drug dealers, a scam, or just a get rich quick scheme. But the day that everybody realizes, a bit like they do with gold right now, that it's not a Ponzi scheme, it's not a currency just for drug dealers, it's not just a get rich quick scheme, and it's not a scam, is the day that Bitcoin could become a medium of exchange. And by medium of exchange, it means that you actually use it to price things. So, a unit of account is when you price things, and a medium of exchange is when you use it as money. I use Bitcoin as a medium of exchange now, but I will always try and spend my fiat money before I spend my Bitcoin in most cases, unless Bitcoin gives me more utility. So if I need to send a large sum of money globally, then Bitcoin is a much, much more preferred methodology of doing that. It's a lot faster, it's a lot cheaper, it's a lot more secure, it's a lot less likely to have counterparty interference, and it's just a really good way of doing that. But if I'm spending on small goods, I wouldn't want to use my Bitcoin. I'd rather just use some of my fiat money, because I know my fiat money is going to go down in value over time. And I hold a belief that Bitcoin, the demand for money you can own, money you can spend, and hard money with a fixed supply will increase over time. Therefore, I think over time it goes up, and therefore it drives people into thinking of it like a store of value rather than medium of exchange. It's too volatile relative to dollars or relative to gold to be a store of value at this stage. But it's still like, a time in history when we're speculating on will it become a store of value, which gives it an asymmetric return bet if that happens, with a high degree of risk, obviously. So that's how I think about that. Now, when will it become a medium of exchange? It may never become a full medium of exchange used globally by everybody. It's more likely that fiat currency will exist as a privacy-sucking, freedom-sucking, disgustingly unliberating form of money that you can't spend, that you can't own, and that will always go down in value over time as it gets the supply of it always increases. But it will be very good for spending as a medium of exchange. Then you will have Bitcoin, which will do what it does. You can't change the properties of Bitcoin. You can't change the supply. But then there'll be technology that exists on top of it, just like stable coins, that allow you to get the best of both worlds. The ability to think in terms of a fiat currency, but spend as easy as spending Bitcoin, and it will be built on top of, at the moment, it's more likely Ethereum, but also things are being looked at whether they could be built on top of Bitcoin as well. So the day it does become a medium of exchange is when the world starts thinking in terms of 8 decimal places, which I don't think the world will ever do. And it will think in terms of milk cost 0.00001234567 Bitcoin. I don't think the world's ever going to think that way. I don't think we can get past 2 decimal places in our head. And I don't think things are going to be priced in Bitcoin. And a medium of exchange is usually the currency that you use when something is priced in the same currency. So if my rent is $1,000 and I have $1,000, I can plan how to pay my rent. If my rent is $1,000 and I have a Bitcoin, it's very hard for me to plan how I pay my rent. And so that's why I think that the big barrier from it going a full global medium of exchange and hyper Bitcoinization, I don't see that world. I see a hybrid world playing a similar role as gold plays today, but also being a hedge against you not being able to access your gold.
Okay, I think our hour is up, but as usual, let's end with a positive high. There's still the after effects, or I think we're coming away from all this lockdown in many parts of the world, and
phase two.
Yeah, phase two. So yeah, we still are waiting for this the Great Depression of 2020. How is that going to play out? But I guess we don't want to think that. What's on your mind, Si? What opportunities are you seeing? And let's leave it there. Thank you.
Yeah, as always, we've got plenty of things that we'll be doing. Again, the phrase that I've always said is that today is one of the most interesting times in financial history. You're going to be alive at a time when we see a monetary renegotiation. Personally, I haven't been alive for any of those yet. I'm glad that I get to actually see that and how that actually plays out. We also get to have a hedge against the traditional markets where you can actually pretty much engage in every single financial product, but outside of the banking system. If you had told me that pre-2008, even 2009, that would exist, I wouldn't have believed you when I started first creating content on my YouTube channel, Simon Dixon. So that's a really positive thing. And also, if you keep following, keep attending the AMAs, I'll keep giving as many insights, and the insights will get better and better depending upon your questions. As we learn new things together, I'll keep keeping you up to date. And also really excited about, we've set some deadlines for end of August for that that 4-part free video series. And then September, I'm going to be working with people that want to build their portfolio, using what I'll be doing throughout the Great Depression of 2020. Personally, I think it has started. It depends on your definition. We won't, if your definition is 3 years of below 10% growth or whatever it might be, then we won't know that until it's too late. But I personally think we have started. And yeah, this either going to be, we'll end with the same phrase which we began with, which is, always remember, no matter how bad it gets, you are alive at one of the most interesting and exciting times in financial history. It's very painful for a lot of people, but I want you to get on the right side of that curve, and I'll keep doing that. If you like, share, subscribe to my YouTube channel, Simon Dixon, and I'll also be bringing you that next episode with Jim Rogers of Bitcoin Hard Talk, where he thinks Bitcoin will go to zero, and I'll give my perspective on why I think it won't. So that's it for this week, and we'll see you next week, and we'll set the topic for next week. If you are watching the recording, comment below, and if you've got suggestions, we'll actually take those topics and see if we can make them happen next week or in future episodes. Also, one final thing I'm going to leave you with. Let us know who you'd like to see on Bitcoin Hard Talk. The way to do that is you can get the first episode. It will come out later this week. And then tweet my name at Simon Dixon Twit and their name, and let us know why we should be on Bitcoin Hard Talk debating. So I'll leave that thought with you. Thank you for your time, and we'll see you next week.